Welcome to Wealth Matters podcast. How are you, Richard, today?
I'm very well, thanks. Thanks for having me on your podcast.
Absolutely. So it seems I'm on fire. I have back-to-back economist or economic analyst on the Wealth Matters podcast. So Richard Duncan is the guest today. He's the author of 3 books on the global economic crisis, including the international bestseller, The Dollar Crisis: Causes, Consequences, Cures, which forecasted the global economic crisis of 2008 with extraordinary accuracy. So, Richard, I don't think I can do justice to your bio. So, would you please give my listeners some idea about what you do now?
Okay, thanks. So I'm an American. I grew up in Kentucky, but after I graduated from university, I ended up backpacking around the world. This was 1983 and 1984
Wow.
for a year, and that was very lucky because I saw Asia. I spent a couple of months in Thailand and Malaysia and Singapore during that time and realized that it was booming economically. So
Right.
I went back to business school for a couple of years, and then after business school, I flew to Hong Kong and found a job working as a securities analyst in a stockbroking company. And I've spent most of my career working in Asia since then, moving around between Hong Kong and Singapore and Thailand.
Wow.
But I've also spent a couple of years in Paris and London and Washington, D.C. So I was the global head of investment strategy for ABN AMRO Asset Management, based in London, looking at all asset classes globally.
Nice.
As a strategist and economist. And I've also worked for the World Bank in Washington as a financial sector specialist. That was during the Asia crisis in 1998, 99, 2000.
Nice.
And then I've written 3 books, as you mentioned.
Right.
And now I'm working on a 4th book. Writing books is my real goal. That's what I see my purpose as being. And in addition to that, I also have a video newsletter called Macro Watch that I sell on a subscription basis. So every couple of weeks, I upload a new video discussing some important development in the global economy and how that's likely to impact the price of stocks, bonds, property, commodities, and currencies. So that's what I do. I now live in Thailand. This morning I'm in northern Thailand, in the countryside outside of Chiang Rai.
Wow. So you pretty much you have worked in US, of course, Europe as well, and Asia a lot. So you have seen the global economy at true scale, and not just someone like me who is sitting in one place for the last 20 years.
I've been very lucky in that I've spent so much of my career in Asia, because so many of the things that happened in Asia then later happened in the US. For instance, I was in Thailand during the early 1990s, from 1990 until 1996. And I watched that blow into an economic bubble that popped in 97 in the Asia crisis. And a few years later, of course, the United States experienced the same thing.
Right. Yep.
So it was really my experiences in Asia that gave me an advantage in having some insight in what was likely to happen in the United States and around the rest of the world. And sadly, even now with the coronavirus, I was living in Hong Kong in 2003 with SARS.
Right. Yes.
That was absolutely terrifying. And this new virus also, of course, it originated in Asia.
Right.
And so we were dealing with it here for a few months before it reached the US.
Correct.
And began doing so much damage there.
Yep.
But so trends in, sadly, both economic and health trends seem to start in Asia. But that has given me an advantage in my career and being able to understand, because I've been able to watch the economic cycles in Asia, that gave me a lot of insight as to what was likely to happen in the United States.
Right. So let me jump on to some questions I have, right? What happened to then US and global equity markets 2 weeks ago or 3 weeks ago, 2 to 3 weeks ago, right? As soon as coronavirus pandemic, what was that? Was that just a blip or correction? What exactly happened?
No, well, so what happened is everyone suddenly realized in the financial markets that the US economy was closing down, that millions, tens of millions of people would be out of work, and that the economy was going to experience a catastrophic contraction, at least in the second quarter, and going on for an unknown number of quarters into the future. And that this would mean that not only would businesses have drastically less cash flow, small businesses, medium-sized businesses, and large corporations, that they would consequently, many of them would be unable to repay their bank loans, and consequently they would go into bankruptcy. And at the same time as millions of Americans lost their jobs, they would be unable to pay their mortgages or their rent or their car payments or their credit cards. And so consequently, they would begin going bankrupt by the millions. And this would result in a systemic financial sector crisis that destroyed the US banking system. Unless the US government jumped in and very radically began providing loans to practically everyone who asked for one. And unless the US central bank, the Fed, jumped in and started providing trillions of dollars to allow the government to be able to finance the loans that it would have to make to keep the economy from collapsing into something as bad or worse than the Great Depression of the 1930s.
Yeah, and I usually don't like Congress and all of that, but I was just surprised at the speed at which they worked to pull this together, right? The $2 trillion bill and all the loans, the EIDL, the Economic Injury and Disaster Loan, or the Paycheck Protection Program loans, etc. I was pretty impressed because, So do you think this is 2000 all over again or no? At this point. And just to remind my listeners, we are recording this on April 6th. And I was chatting with Richard before as well. And as per him and how I'm seeing the market, things are changing day by day, right? So this could be outdated by the time you guys listen to this episode.
Right. So on March 15th, I uploaded a Macro Watch video called Recession or Depression. And the theme of that video was whether or not this crisis turns into a recession or depression depends entirely on how quickly the US government begins providing loans on an enormous scale to anyone who asks for one, more or less. And how, so in other words, it depended on the size and the speed of the fiscal and the monetary policy response to the crisis. Well, just a few hours after I published the video, the Fed had an emergency meeting on that Sunday. Basically, infinite QE is what they're calling it. That they would create as much money as necessary to ensure that there's sufficient liquidity to prevent this, to prevent our economy from collapsing entirely. And so, like you said, I also was impressed that the Congress acted as quickly as it did in coming up with this $2 trillion fiscal rescue policy. Now, I don't think that will be enough. The budget, the deficits they're going to have to be more fiscal stimulus programs, and the Fed is going to have to print a great deal more money or create a great deal more money than it has. I mean, just in the last 3 weeks, the Fed has created $1.5 trillion.
Right.
That is a 35% increase in the amount of the Fed's balance sheet in just 3 weeks.
Wow.
So it's now up to 5.8 trillion. But this is going to become very much larger. It wouldn't be at all shocking if the Fed's balance sheet, if they created $5 trillion over the course of this year, before the year ends, taking their balance sheet up to $9 trillion.
And can you describe why they would have to go from 2 trillion to 5 trillion? will we run out of this $2 trillion fund in a month or 3 months or?
Yes, I think people are going to remain out of work, as
Right.
you no doubt saw. Over the last 2 weeks, 10 million Americans filed for
Right.
unemployment insurance, and that number is going to become very much larger over the next few weeks. And so tens of millions, well, certainly millions, and probably more than 20 million Americans are going to be out of work. And it's not going to be just for 1 month or two, probably. This is probably going to last for a while.
Right.
And these people are going to have to be given money by the government, or else they won't be able to pay their rent or anything else, and the financial system will collapse.
Yeah.
And on top and worse than that, of course, people will go hungry.
Right.
So as long as the government can continue providing this money, that's what they're going to have to do.
Right.
And luckily, the United States is a very wealthy country.
Oh yeah.
There's almost no limit as to how much the government can spend.
Right. There is no gold standard, right? I can print as much as I want.
That's right. I mean, this is a very important lesson. Back in the 1930s, there was a gold standard, and the Fed couldn't print as much money as it wanted. It was very constrained. And so the options were limited, and the banks, a third of the banks failed, and the U.S. went into a depression. The unemployment went up to 25%. It lasted for a decade, and it didn't end by itself. It only ended with the massive fiscal stimulus that resulted in World War II. World War II, the government spending increased. The government debt rose by 5 times during World War II. And the Fed's balance sheet increased by 11. The Fed's holding of U.S. government debt increased by 11 times during those 4 years alone. So right now, the U.S. government debt at the end of last year was something like 107% of GDP.
Wow.
Well, the GDP, the size of the economy, let's call it $21 trillion or $22 trillion. So even if the government had to spend $22 trillion, which is an extreme example, but even if they had to spend that much, keeping the economy from collapsing into a depression, that would double the ratio of debt to GDP, to 214% of GDP. But Japan's government already has more than that.
Yeah, way more.
240% government debt to GDP. So there's essentially no limit as to how much money the government can borrow and spend, and the Fed can finance as much of that as necessary.
And now and also it helps, right? At 0% interest rate.
That's right. Interest rates are zero, and so that's what we're going to see. We're going to see very large budget deficits, and we're going to see an extraordinary expansion of the amount of money that the Fed creates. And if they continue doing this aggressively enough, then we won't collapse into a 10-year Great Depression.
Got it. So do you think the interest rates would stay compressed or this low for foreseeable future? Because we'll be creating so much money.
Yes, so there are a couple of things to think about. Now, first, interest rates are affected by one thing, by the supply and the demand for money. So you would think that if the government borrows a lot more, that's called crowding out back in the old days. If the government borrowed a lot of money, that would push up interest rates. But that was in the old days when there was only a limited amount of money. Now that the Fed can create as much money as it wants, so the demand for money goes up from the government, but the supply of money goes up from the Fed. So that's really no longer a factor. Now, the most important factor next is the inflation rate. Now, inflation is driven by a number of different factors, 3 main factors, in fact. One is the money supply, the growth in the money supply. In the past, if there was very, very rapid growth in the money supply, as there is now, then that would typically lead to high rates of inflation, or even in some instances, hyperinflation. But that has also changed. That doesn't work the way it did in the past either, because in the past, before 1980, the United States had a relatively closed economy. In other words, there was U.S. trade was in balance.
Yep.
So if the US government spent a lot of money and the Fed printed a lot of money, it made the US economy overheat. Everyone had a job, there was full industrial capacity utilization, and prices started going up, wages and prices. But now that we have globalization, and now that the US has been running extraordinarily large trade deficits since the 1980s,
yes,
it no longer works that way. High rates of money supply growth. We saw the amount of money the Fed created increased by 5 times between 2007 and 2014.
yes.
But we didn't get high rates of inflation then because we have globalization. We buy things now from other countries with extremely low wages.
I see.
So that globalization is extremely deflationary. So as long as globalization persists, then that very large increase in the amount of money the Fed is going to create won't necessarily cause consumer price inflation in the United States. However, if globalization breaks down in this crisis, and there's some indication that it might, of course, it was under siege to some extent beforehand with the trade war between the US and China. But now there are increasing calls for American factories to bring their production back to the US so that we will have a sufficient number of ventilators and sufficient sufficient medicine. So depending on the extent to which globalization is reversed, that increases the risk that there would be higher rates of inflation. But there are 2 other factors that affect inflation rates. One, demand shocks, and 2, supply shocks. For instance, there are inflationary demand shocks, like wars. Wars generally, countries have to expand their production, that increases demand and that pushes up prices. But there are also deflationary demand shocks, and that's what we're experiencing now. Now that everyone is required to remain home, people aren't spending, and so demand is dropping. So this is right now what we're seeing is a very deflationary demand shock. And that's what we're going to experience initially, more deflationary pressures. But then there are also supply shocks, deflationary supply shocks and inflationary supply shocks. So for example, inflationary supply shocks is when OPEC cut off the oil supply in the 70s. So that caused inflation. But there are also deflationary demand shocks.
Which we are just witnessing right now.
Deflationary supply shocks like globalization, which because of globalization, that causes a radical expansion of supply, and that pushes prices down. So initially, we're going to see deflationary pressures because of the collapse in demand. But in some products that are scarce, ventilators and face masks, I suppose, those prices could increase. And depending on how long this crisis goes on, we may see more and more shortages of various types of products if production shuts down and the supply dries up. So in the short term, it's deflationary. In the longer term, we may see more inflationary pressures, and over the sort of the medium to long term, whether or not we get inflation as a result of all of the paper money that Fed will create will depend on whether globalization persists or globalization collapses. If globalization collapses, then we're going to get high rates of inflation. And that's going to be very bad because it will push interest rates very much higher. But on the other hand, it's probably not going to be one or the other. We're not going to go back to the kind of globalization we had 5 years ago. But on the other hand, globalization probably won't collapse entirely either. So we probably are going to be able to avoid very high rates of inflation. But we'll just have to see how events play out. No one knows how long this is going to last, and no one really can tell you to what extent and how much globalization will break down.
No, thank you. This was a great explanation. So, is this recession or depression?
You have all the leading investment banks saying that in the second quarter, the GDP is going to contract by more than
which is
20
guaranteed.
by more than 20% on
Yeah.
an annualized basis. So, there's no set definition for depression, but I think that probably qualifies. Now, whether how bad it is in the third quarter and the fourth quarter, that's a different matter. And for the full year, the economy is certainly going to contract, but we don't know whether it's going to contract by 2% or 6% or 10% or more. That will all depend on how long the virus lasts. But this event is considerably worse than the crisis of 2008. So it is the worst shock since the 1930s.
Wow. So do you see this as, let's say it's a recession and we contract for 2 consecutive quarters. Do you see this as a short-term recession or long-term recession?
Well, again, that's just going to depend on how long the virus persists and how long it spreads and how long the economy has to remain shut down. But I don't think we're going to have a very quick recovery.
No.
And people are not going to go back flying around on airplanes and taking
Right.
cruises.
Oh, yeah.
Anytime soon.
I usually travel once a month, right, to take a look at the properties and if I put an offer and whatnot, because I invest in real estate. And of course, I haven't traveled since February, right? And I'm not going to travel for some time.
So
right.
So the size of the economy next year in 2021 is unlikely to be as large as it was last year in 2019.
Of course.
And it may not recover in the following year either. It may not surpass 2019 levels even in 2022.
Oh, okay. So you don't anticipate and I have been reading a lot as well as listening to or attending a lot of webinars, and they've been comparing it to V-shaped recovery. Some are saying it could be U-shaped recovery. Do you think it would be one of those or something else?
I think it would be something closer to an incomplete U.
Oh, okay.
It stays down for a while and then it goes back up, but it doesn't go back up as far as it came down.
Oh,
it doesn't
okay.
go back up to its previous level anytime in the immediate foreseeable future.
I see. So it's something, because someone mentioned a hockey stick or Nike swoosh, but you don't anticipate something like that, because that means it would recover and go much higher, right?
Well, everyone has to keep in mind to begin with that all of these scenarios are taking into consideration the radical expansion of government spending,
right, of course,
and the size of the Fed's balance sheet. Otherwise, it would be just a very long, straight arrow down.
Okay.
And so much of the recovery depends on those factors. If, for instance, the U.S. government, in addition to this $2 trillion, I mean, just for an extreme example here to make a point, if the government announced that it was going to spend an additional $10 trillion over the next 3 years, investing in new industries and technologies like artificial intelligence, biotech, genetic engineering, robotics, neurosciences, and all of the other industries of the future on a $10 trillion scale, then yes, we would have an extraordinarily rapid expansion of the economy. We would have an incredible economic boom that would make the economy far bigger than it was in 2019. So, and it would also improve productivity for future years. So it all depends on how much the government spends and how it spends it. Now, many people, we've seen President Trump call for an additional $2 trillion government program to invest in infrastructure. So that would certainly that would help the economy. But rather than just stop at investing infrastructure, the thing that I have been encouraging the government to do and advocating in my Macro Watch videos is rather than just, it would be great if the U.S. had better roads and bridges, but better roads and bridges aren't going to increase the United States competitiveness relative to China. relative to China, which is investing very aggressively in the industries of the future and is currently
Yes.
investing more than the United States does.
Yeah, that's what
So
I heard, right? They are spending way more in R&D than United States does right
that's
now.
right. So if the current trends continue, within the next decade or two, China will be the undisputed international superpower, economically, technologically, and
Wow.
militarily.
Wow.
And so if the government is going to start spending on infrastructure, we shouldn't just spend on rebuilding the roads. We need to invest in the industries of the future so that we can retain our global preeminence and national security for decades into the future.
Makes sense. That's awesome. So I'm going to be selfish and ask some questions from investors' perspective. So what should an investor, let's say equity investor, should do now? To wait and watch because Dow jumped 1,600 points today, and now people are saying, "Oh, we are in recovery mode." Or do you think there'll be more up and down, or it would just stay volatile? So what should an investor
Yes,
do?
so there is no one typical investor. I mean, how much money
Right,
does your investor have? An investor with $10,000 is a different case from an
right.
investor with $1 billion.
That's true.
So every individual needs to take into consideration his own circumstances and his own risk tolerance, and his ability to, last this out over the long run. No one can tell you for sure what is going to happen with the stock market. The stock market is wildly volatile. I mean, for
Yes.
instance, let me tell you my own personal experience. When I was just starting off my career in Hong Kong I started working there in 1986. And over the first 12 months that I was in Hong Kong, the stock market went up 100%.
Wow.
And the economy grew by 13%,
Wow.
the GDP growth. And I woke up the next morning and turned on the television, and the US stock market had fallen 23% overnight. And the Hong Kong stock market, when it reopened down 50%.
That's crazy.
And the stocks, crazy speculative stocks that I'd been punting in like a
Yeah.
madman, they
They
were
are they
down.
are done.
They were like down 90%.
Right.
So every stock market investor needs to be aware of that is the risk that I have personally experienced. And are you willing to tolerate those risks, or are you
Right.
not? If you can, then and feeling lucky, throw the dice. But I personally, I don't think that the stock market is going to go back to anywhere near the levels that it was a few months ago, and it's quite possible that it's going to test new lows and potentially significantly lower
Yeah,
than it's
and
already been.
that's what I think as well. But yeah, of course, some people refuse to believe me. I
But
think it's
again,
definitely by end of the year we'll see much lower low.
but you have to consider many different scenarios. For instance, personally, I think it would be a good idea if the Fed started directly buying stocks. If the
Ah,
Fed started buying stocks, which is a possibility you can't rule out, they're already buying practically everything else. If
right.
they started buying stocks to push stock prices higher, then yes, stocks could go to record highs.
That's true.
Or it could double. You can't rule out any real
Yeah.
scenario.
And that's exactly what happened. Not that Fed was buying the stocks, but companies were buying back their stocks, right? I think the last rally for last couple of years has been fueled by stock buybacks, right?
So our economy, I think, is important. If people really want to understand how the economy works these days, the way it works is it's driven by credit growth. Credit
Mm-hmm.
growth has been driving economic growth in the United States for many decades. And anytime it grows by less than 2% adjusted for inflation, then the US has gone into a recession.
Ah,
And the
right,
recession doesn't end until we get another big surge of credit growth.
right.
Since 2008, credit has been too weak to drive the economy, so the Fed has been pushing up the stock
Yep,
market.
yeah, yeah,
And so asset price inflation has been supplementing credit growth in
yeah.
order to make the economy grow. But now the coronavirus is threatening to cause credit to contract radically as people default. And at the same time, it's crushed the asset prices and creating an extremely negative wealth effect. These two things together, contracting credit and collapsing asset prices, are certainly enough to throw the U.S. into an extreme recession or even a depression. So rather than allowing the stock market just to collapse, if that, in fact, we start to see that again, it makes a lot more sense for the Fed just to start buying stocks and to push the stock back up. Because if they allow the stock market to fall 50%, then that's going to make the banks and the banking system go bankrupt. And it's going to be very expensive to bail out the banks. It wouldn't be, again, because you've got to bail out the banks, because if you don't bail out the banks, then everyone's savings are destroyed.
Yeah.
So it'd be a lot cheaper for the Fed just to buy the stocks and push up the stocks than to allow the banking system to collapse. And if the Fed announced that it was going to start buying stocks, then it wouldn't have to spend very much money, because every investment manager in the world would know the stock market's going to go up, and they would all start buying stocks too.
Yep.
Or else they would lose their jobs when they're performed. So these are unprecedented times, and if things become worse, then I wouldn't be surprised if the Fed bought stocks directly. So, really, whether you invest in stocks or not depends on how lucky you're feeling. You can try. Some people might want to bet on shorting them. Some people might want to bet on going long. But it's really just depends on your luck.
So, will the real estate market crash because of coronavirus?
So all of the assets in the country, all the assets, all the value of all the property, and all the value of all the stocks, and all the value of all the other assets in the country, all the wealth of the country is floating on an ocean of credit. If credit expands, the prices go up. If credit contracts, the prices go down. If credit contracts a lot, then prices collapse. So if bankruptcies soar, as they will without adequate government support, then credit will contract, and it wouldn't be surprising to see property prices become significantly lower. But in that scenario, however, every asset class would become significantly less valuable. And if you have, I'm a big believer in owning land, preferably with a house on top of it that you can rent out.
Right, and that's what I do.
So I'm not talking about investing in condominiums.
No.
There's no limit as to how many condominiums you can build.
Correct.
But if you own land with a house on top that you can rent out, then, okay, even if all the asset prices fall, at least you will still have some rental income.
Right.
And moreover, you can grow vegetables on it.
Can't go wrong.
Whereas land behaves much the same way as gold, except gold is a lot easier to steal.
Yes.
And gold, you have to pay people to watch it for you.
Right.
And if you have a lot of gold, it's not really, and you have it in the safe somewhere in or Singapore, it's not going to do you a lot of good. And it doesn't have any cash flow.
Yeah, exactly.
So,
and we don't build land, right? You can still mine gold. We can't build just land.
Precisely. So, I believe everyone should have some gold, just as I like to say, just in case you need to get out of town fast.
Correct.
But if you have a lot of money to invest, personally, I believe it just makes much more sense to have it invested in a real asset, a very tangible cash flow generating asset like land.
That's awesome. And that's what I do. And my listeners are focused mainly on investing in single family residences to apartment buildings, self-storage facilities, mobile home parks, etc. Right. So yes, I always preach that as long as your investment makes some cash and you are able to ride out the wave, right? So if your investment is covering your mortgage and all the expenses, then you can definitely survive a downturn, right?
Well, that's right. But of course, you do in this sort of crisis, you have to be prepared for your rent to drop.
Right. Yes. It is
And
going to drop.
you have to be able to ride that out as well.
Yep.
So yes, you
Great.
have to strike the right balance between how much leverage you want to have against a
Yes.
rental property portfolio.
No, that makes sense. So last couple of questions. Any real estate or finance books you recommend?
Well, so on my website, I have a tab. If you go to my website, richardduncaneconomics.com, richardduncaneconomics.com,
Yes,
and
I say it. Yes, books
look
I
in the menu
recommend.
bar.
Yep.
There is a tab called Books I Recommend. And there are a lot of economic books and history books, all kinds of books that I think all of your listeners should read. That
That's
will give
awesome.
them plenty to do over the next year.
Yes. That's awesome.
Starting with my books, I might add.
Of
There are
course.
three of
Of
those.
course. Any website or apps if someone wants to know or understand more about investment, real estate, etc. You personally you recommend?
Well, so yeah, look, let me plug my own website. It's one, as I mentioned, I have a video newsletter
Yes.
called Macro Watch. And this I launched 6.5 years ago. There are now, every couple of weeks, I upload a new video. Each video is usually 15 or 20 minutes long and has roughly, 25 or more charts that you can download. Now, these, of course, have been on various topics, but I group these videos together under their various topics. And there are now probably, when I got to 50 hours of videos, I stopped counting. But I suppose there's somewhere near 70 hours of videos. And these are grouped under, I've also grouped some of these together as courses. There are 4 courses. One is called Understanding Monetary Policy. And one is called China's Economic Crisis. One is called How the Economy Really Works. And one is called Capitalism in Crisis. And more recently, I've done a series of videos just on the coronavirus crisis.
That's great.
So if you want to understand how the economy works, I recommend you subscribe to Macro Watch. And by the way, if your listeners would like to subscribe, I'd like to offer them a 50% discount. If they go to the website, richardduncaneconomics.com, and hit the subscribe button, they will be prompted to put in a discount coupon code. If they use the coupon code MATTERS, MATTERS, they can subscribe at a 50% discount.
That's awesome. So generous of you. Thank you.
And while they're there, at the very least, they can sign up for my free blog if they would like to do that.
Yes, and I will highly recommend checking out richardduncaneconomics.com, and I'll also put this coupon code as well as the website in the show notes as well. So if anyone wants to check it out.
Okay.
Thank you so much, Richard. I thoroughly enjoyed the episode. I appreciate it.
Thank you. I enjoyed speaking with you. Best of luck and take good care.
Take care.